Awesome. All right. Hello, everyone. So excited to be on. Hold on. Hold on. I'm trying to get some things open, ready for you all. If I can get this to work, this would be great. Hold on, guys. Hold on. Hold on. Just getting some stuff here. Okay. All right. I have the rest of stuff here. Good. What's up, everybody? I'm back. It's so good to be back to our summer session. Really excited about today's segment because we're going to be talking to two groups of people, employees and employers or business owners. Okay. So it's going to be such a cool segment today. And I'll probably do something I've never done before, which is go live and share my screen. You all pray for me that when I hit the share button, that I don't make a mess. So let me see. I have to make sure that my team is having my back on this one. But today's session is really an exciting one for me. And first, I have to apologize for the time change. I know a lot of people were expecting for us to do this at 3 p.m., but due to some changes in our schedule, we kind of had to move this. But I'm so glad for those who can make it. The information is still going to be here recorded so you can reference it whenever you're ready. All right. Today's segment, we're covering two things. We're going to be talking about your W-2 withholdings, which is what you do when you complete your W-4. So we're talking about employee withholdings. I shouldn't say W-2. We use that kind of language a lot when we're talking amongst us in the firm, but when we're talking about withholdings, we're referring to employee withholding. So today we'll be talking about that, helping you understand your employee withholdings. And I'm also going to walk you guys through how to complete your form correctly. A lot of times when people come to file taxes, that's where they go, oh snap, I did not know I was supposed to do this, I did not know I was supposed to do that. And the conversation only starts after they have realized that they're owing a lot of money back to the IRS. And it's my hope that you're informed enough where even if you don't want to have to owe, or some people don't even want to get a big refund back, but you know enough to be able to break even. So that's really what this conversation is about. So I did make some notes and I was sitting here writing, trying to grab something real quick. I'm just grabbing this for me over here because I like to write. Are there people in the in the room that like to write like me? Because I like taking notes. I'm always writing stuff. When we have so much to talk about, I should make sure my thoughts are organized because when I get excited, I just go. I just go. The other day in one of my accounting classes in the MBA program at Regent University, one of the students asked me about a tax strategy, and I just went crazy. When you ask me about stuff I like to talk about, you're going to have to pray and for me to come back to order. So I try to make notes for you guys so I don't get too excited and go off topic. No, I never go off topic. I just put too much emphasis on the ones I love to talk about. So that will not be the case today. So let's dive right in. Like I said earlier, we will be breaking down employee withholdings, right? My hope is that you would understand what those withholdings are. You would understand how to complete your W-4 so that you're withholding the right amount of money so you don't end up owing the IRS or the government, state or federal. And even if you don't want to get a big refund, you at least break even. Okay. So per the laws in the US, everyone who works as an employee, there's a certain amount that your employer is expected to withhold from your paycheck, right? Now, there are several things that come out of your paycheck. When you sign an agreement with a company and you're hired on, and they say this is your salary, generally what they are telling you is your gross. Okay, so you went in, you got a great contract. They're like, we want to have you. We're going to be paying you six figures. That's 100 grand. I'm like, I have arrived. Okay, I'm going to be making over $8,000 a month. That's great. Except even though that gross is $100,000, you might end up getting only about 70,000 or 70 something thousand into your account. Why? Because there are several withholdings that have to be taken out of their paycheck before you get the net. Okay. So when you hear people say, I'm making this amount or that amount, a lot of times it's not what's reaching their bank account. So don't be envying someone because they might not be getting that in their bank account. Okay. It's just what's on their contract, but it's all good. All right. So, what do those withholdings entail? Well, the first thing that comes out of your gross is usually your federal income tax. This is very important. Your federal income tax is the income, I mean, it's the tax that you're paying for income that you're earning, if that makes sense. Okay. So, you have your federal income tax, and then for those who are in a state that pays state income tax, they also have to pay income taxes to their states. All right. You already know what taxes are used for different things, whether it's going towards putting systems in place, infrastructure, war, whatever it is. But you pay your share of income taxes for money that you earn. And everybody pays income taxes, by the way. Business owners pay income taxes on the profit that they make because it's income that they are earning. Everybody pays income taxes. So right off your gross, income taxes get taken out. All right. And then next to that, now you have what we call Social Security and Medicare. We call them FICA taxes. So everyone contributes to Social Security and Medicare because when you do retire at some point, you want to at least have the system support you throughout that. Okay. Or if you have some health issues, sometimes the system will support you. So the Social Security and Medicare, the gross amount, all right, for both of them is 15.3%. But when you work for somebody as an employee, you only pay half of that amount, which is 7.65%. And then your employer pays the other half. Okay. So remember, income tax is out, then your Social Security and your Medicare taxes come out. Now, what's the tricky part with these? Social Security and Medicare taxes, you don't have any control over that. It's pretty standard. Whatever you're getting paid, the rate at which you would be taxed is pretty straightforward. Okay, you see that 7.65% combined, that's what will be taken out of your paycheck. You have no control. Your federal income tax is usually what you might have control over. All right. Now, there are other deductions that come out of your paycheck, like if you're making contributions to your retirement account, if you're paying for, if you're getting health benefits and those kind of things. Those are also amounts that come out of your paycheck. Now, depending on what type of accounts they are, those that are pre-tax, right? Like your retirement account, when you contribute to 401k, they call it pre-tax contributions. What that means is before the calculation on your income taxes is done, that money is taken out. So you don't get to pay tax on that money right away. You pay tax on that money when you retire, or if it has a purpose, when you fail to use it for that purpose. I'll give an example of an HSA. An HSA is a health savings account. So if you put money towards an HSA, it's pre-tax money. If you use the money for health reasons, you never have to pay taxes on it. But if you don't, then you withdraw the money for personal things, you would have to pay the taxes later. For retirement, you're free to contribute pre-tax to your retirement account. You don't have to, the taxes are not taken now, but when you withdraw the money when you retire, then you pay taxes at that time. All right. So these are the different things that go into that are taken out of your paycheck. So you get your gross. Out of your gross, you have your federal and state income taxes. You have your Social Security and Medicare, which is pretty straightforward. You have your different benefits that are also being deducted. And then there are certain states that have local taxes that get collected, like Ohio, Pennsylvania. They also have local taxes that are taken from your local jurisdiction that goes towards schools and things like that. Those come out of your paycheck. All right. So just to give you an idea of what it looks like when you receive your pay, your net, okay? All these things have been taken out. So let's talk about it. When really do you have to complete this W-4? A W-4 is the form you complete to let your employer know how much income tax they need to take out. All right? So remember, I gave you all these other things, but they don't play a role when you're completing a W-4. A W-4 is a form that you complete in order to let your employer know how much income taxes needs to be taken out of your paycheck. Very important, right? Your Social Security and Medicare is straightforward. Your benefits depends on which ones you elect for. State tax, most of them are usually fixed, but depending on how much you want withheld, sorry, local taxes, but state taxes, state income taxes, you also would complete a form for the state to do their withholdings. So the W-4 is what you would do at the federal level, and then the different states have their own kind of W-4 that you would complete. But the goal of this is for you to be able to tell them how much they should take out for income taxes. All right. Now, when should you make changes to this form? Because sometimes when people complete a W-4, they feel like, oh, it's set and it's done. All right. No, you can always make changes. So the first thing you complete a W-4 form to let your employer know how much to take out when you get a job, right? When you get hired and you're a full-time employee. 1099 independent contractor, you don't complete the W-4. W-4 is only for employees that are hired by a company. And this company is committing that they're going to be paying half of those other taxes for you, and you pay the other one, you're going to do work, they'll pay you, blah, blah, blah. All right. So they give you a W-4, you complete it. But you can go through different changes in your life that might require you to complete a W-4. One of them is if you got married. You definitely want to make sure that you adjust your W-4 withholdings, because if you and your spouse are going to be filing jointly, you want to make sure that you guys are completing your forms, taking into consideration that you're a two-income household. All right. Even if you're not a two-income household, that there have been changes in your finances, right? Either if you have still one income, but there's an additional person that is being added to your household, you want to make those changes. You can change or update your W-4 when you have a baby. Okay. There are usually tax credits that you get when you have a kid, so you can choose to update. You can also update if you felt like you filed your taxes and you were owing a significant amount of taxes. You want to make those adjustments so that way you don't end up owing more in taxes. Okay. And sometimes maybe if you got a lot more money. Another thing you can do is if you start getting income from other sources that you're not able to withhold taxes on, and you want your employer to withhold enough federal income tax for you so it can offset some of the taxes from those other sources of income, you can include it. Okay. So let's say you're collecting rental income and you're making it's quite profitable, but you're not paying any taxes out of that. You can have your employer withhold additional taxes for you. And guess what? Your W-4 allows you to enter that kind of information. Okay. So and then also if you started doing a side gig where you're like, I am not sure if I want to start filing the 1040 ES to do estimated taxes, I can just have additional taxes taken out of my paycheck. Up to you. Okay. If you decide to get a second job, I think it's also good for you to make an adjustment to your W-4. All right. These things are very important, because when you don't adjust your W-4, guess what? You're going to under withhold, and you're going to end up owing. Let me tell you guys, there's nothing as painful as owing the IRS. Do you hear me? Like, that money, it's better for you to break even. But when you owe, because if you don't pay on time, penalties accrue, interest accrue, depending on if you file your taxes on time as well, or you did an extension. But it's never fun. So it's my hope that, with this information I'm sharing, you're going to take the time to follow through, complete your W-4 correctly, so you don't end up on the wrong side of Uncle Sam. All right. So I told you guys today I'm going to share my screen so we can do the W-4 completion together. And I hope that this helps someone. Okay. There are 5 major segments when you're completing the W-4. So I hope that we can go through and I can give you guys some guidance, and then things that you should pay attention to when you are a married person, for example, because sometimes married people don't realize that there are some things that they are doing wrong that is causing them to owe as a household. All right. So I'm going to share my screen. Let's make sure that I'm good, you guys. Let me not share here. And okay, good. So this is me sharing my screen right now. So over here, this is a W-4 form. Okay. I want to make sure that I have this here for someone who is going to come back and watch this, and you would want to sit down and complete this form on your own. Okay. So the first step in completing this form is providing your information. You want to make sure that you get this information right. All right. So it starts with your name, your middle initial, your last name, and your social security number. Very important. You want to avoid making errors, because if you make an error with your social security number, what's going to happen is they're going to be reporting your social security and Medicare taxes under somebody else's social security. You don't want that, okay? You want to, of course, provide your most recent address, or the address that you want to be able to receive mails to. And then you want to indicate if you're single, or if you're married, filing separate. If you're filing single, or you're married filing separate, you both use the same standard deduction on taxes. So that's why this category is together. The next one is if you're married filing jointly, or if you are a qualifying surviving spouse. Your spouse passed away and you're a surviving spouse. All right. And then the last one is head of household, where you're not married, but you have kids or you have dependents that you have to claim on your taxes. You do want to make that a selection, because it really plays a role in determining how much taxes will be taken out of your paycheck. All right. So, for example, if I put married filing jointly, automatically less taxes will be withheld from my paycheck compared to if I was single, right then and there. Okay. So, some things to keep in mind. So, once we're done with this first part and we've selected our filing, our marriage status, the next thing we want to go to is figure out, if you're filing jointly, you and your spouse, do you have uh, 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 two sources of income? There is a form, there's an estimator in the IRS website. I encourage everyone to go use it. It's always good to go into this form. It says, let me see if I can highlight it. It's right here, www.irs.gov/W4app. When you go there and you enter your income, it really helps you guys with giving a good estimate of how much you should have taken out of your paycheck. Now, for those who are like, yeah, I don't want to stress myself about that, I don't want to do all of that. Okay, there is a sheet at the very bottom over here. I'll just scroll here. When you complete this form, if you come to the very last part here, you're going to see where people are married filing jointly, right? And one person is earning maybe higher income, another one is paying lower income, and you can follow based on the range of your income, both of you and your spouse, and you can find the rate, the amount that you guys should be able to withhold. This is incredible. I don't think a lot of people leverage this tool. And if you feel like it's confusing, feel free to schedule an appointment with our office. I'll be happy to walk you through your own specific situation. Okay. Now, once you have been able to clarify that, you want to come now to step 3. Okay. Step 3 is very important. Step 3 is where you are claiming your dependents. So on here, if you have multiple kids under the age of 17, the tax credit that you get for each child right now, as it was increased, is $2,200. So anytime you indicate that you have a dependent, right then, less taxes are going to be withheld for you. Okay. So if you have multiple dependents, right? Let's say you have 2 or 3. Let's do 2. That's 4,400 from your paycheck that will no longer be taken out. So less taxes will be taken out. Really great. If you have dependents that are over the age of 17, like 18 and up, right? If they are full-time students and they live in your house, you get a $500 credit for them. Okay. So because you get that credit, your taxes your withholdings get adjusted accordingly, because you're going to get that credit. Now, do you necessarily have to put it? Not all the time. There are people who want to get a big refund at the end of the day, and they're like, I'd rather have them take out more taxes. But I want to point out something here. This is the part where I was coming to. If you and your spouse work, 2 of you cannot claim the same number of kids on your paychecks. You're going to get yourself in a tough spot. Okay. So if you have 2 kids, you and your spouse work together. All right. The 2 kids means you get a total of 4,400 tax credit. Now, if you went and put 2 kids, right? If you multiply this, you put 4,400, and your spouse on their own job put the same 2 kids, 4,400. That's a combined credit of $8,800. So you're going to have your withholdings less, but guess what? You're only getting 4,400 in credit. So it will be better for one person to claim the kids, or one person claims one child and the other person claims another child. Pay attention to this. This is one of the biggest errors I see married couples make when it comes to their withholding. Very, very important. All right. So if you have a dependent that is over 18, two of you should not claim that dependent because you're only going to get $500 credit for one. But now I have 500, my husband has 500. That's $1,000, but we're only getting 500. So guess what's going to happen at the end of the day? We're going to owe 500. Same with the other kids. So this is something to pay attention to if you're married. All right. Now, the part I wanted to talk to today before I get done with this is this step 4. I think step 4 is such a game changer. All right. So remember when I was talking about the times when you can make updates to your W4, one of them is if you picked up a job or you're getting, let's not do a job, you're getting income from a source that you maybe you're not withholding taxes from. Okay. Like rental income and things like that. So what you could do is if you want your employer to withhold more taxes from your job, so that way it can offset the income from the other jobs, you can go ahead and fill this 4A. Isn't that amazing, right? So this one now, if you want to have taxes taken out, you can go ahead and do it here and it's going to have them withhold more taxes from your paycheck. I think it's such a good one. All right. Then now, another one that you can choose to do, this where you say deductions, which is 4B. So that was 4A. If you got a job, no, not a job, if you have income where you're not getting taxes taken out, you can do complete 4A because this is income from other sources and it's going to help the employer to take out more taxes for you, which is going to help to offset some of, the taxes that could have been taken out from the other income and then you may end up not owing. Okay. 4B now is where you want to do your deductions. So what are some of these deductions? So let me give an example. Now we have with the new tax law, we have a break for people that are in the service business, restaurant business, that get a break from their tips. Okay. So if let's say you qualify to be able to get the tax break from tips, you can go ahead and put the information in here. All right. So you can put some of those deductions you can get. If you are going to itemize, you can actually go ahead and complete this part here to provide some of those additional deductions that you're going to get. It's amazing. All right. Now, the last one, now remember the part of extra withholding. I mean, the part of doing this form if you get another job or if you're a business owner, if you got a side gig, right? So with a side gig, especially, let's say you're getting a 1099 at the end of the year to file your taxes, but you know that you did not do any withholdings throughout the year, every quarter to send to Uncle Sam. Now, to make your life easier, you could actually just have your job do an extra withholding on 4C. But it doesn't end there. If you're someone who feels like you're always owing taxes, what you can do is you can also put an amount in 4C to have them withhold additional money every paycheck. So you can do an extra $100, extra $200, $250. Those people that earn quite a bit of money, where when you complete your form, you still feel like they're not withholding enough, you can tell them to withhold extra from every paycheck. All right, in 4C. And then we'll move to the final part, which is to make sure that you sign, because if you do not sign, it's not going to be accepted. It needs to be signed and dated. All right. I hope this helps you guys. If you have any issues or if you're struggling, please feel free to reach out to our company. Getting your W4 done right is going to give you a lot of peace. I see people come to the office during tax season and we work on their taxes and they're so surprised they're owing taxes. A lot of it is because of this. A lot of it is because they did not get their W4 completed correctly. And if they were married, they didn't know that each other's W4 will impact the other when they file taxes. All right. So if you need additional guidance, do not hesitate to reach out to our office. I'll be more than happy to help you with this. All right. I'm going to stop sharing. This was neat. I was very concerned about this sharing thing, but I feel like I did great. What do you guys think? Good. All right, so let me get back to it because I'm moving to a part of the presentation I love the most. All right, so we just talked about understanding your W4, your employee withholdings. You see, I need to stop doing this. Understanding your employee withholdings, right? So that way you know what comes out of your paycheck, because when they tell you they're going to pay you 100 grand, you're only getting 70 grand Why did that happen? Right? So these are the things for you to understand the different taxes that have to be taken out. But the most important part is the federal income tax. And for you to determine how much needs to be taken out, you need to fill your W-4 correctly. I hope that this helps you guys. If you can reference this, if and it helps you, please let us know. If you need additional support, do not hesitate to reach out to us. All right. Thank you. So now let's hop into business entity structures. Okay. So there are a lot of you out here. If you haven't already tried starting a business, I'm sure you're thinking about it. And down the road, you're like, look, I want to go and register at my LLC, or I want to start this business. And you're in the right place and you're listening to the right person, because this your favorite CPA over here wants to make sure that you have the right information when it comes to setting up your business, choosing the right entity structure, not only for the business structuring and organization, but also for tax optimization, because that's very important on this. Okay. So I hope that we can kind of talk about the tax implications of the different entity structures that are available. Okay. So when you are, thinking about starting a business, you're like, this is what I want to do. There are a couple of things I want you to think about. Okay. So first of all, is this a business that you want to do long term? It's very important. Uh, just because someone tells you your business is great doesn't necessarily mean you want to be in this for a long run, right? So you want to ask yourself, is this something I want to do long term, right? See, I didn't even start with the why part. I'm still talking about just the business, because if you've listened to me, I'm always big on why, why. You always have to ask yourself, why should I even be doing this? All right. So that part you always want to clarify. Why should you even be doing the business? But if you have decided that you want to start a business, which is where I'm meeting you right now, the question now is this something I'm just testing out, or is this something I want to do long term? It's very important, because sometimes people rush and go register a business entity when they actually don't need to do that. Okay. And we're going to break it down, the different entity structures, so you see where you are and what will best serve you. But the important thing is this something that you want to do long term? Because if you go set up an entity that you end up not using, and then you're paying money to the state every day to keep this business entity structure, that's a waste of resources. All right. And I'm sure that we all want to save our money, not just spend it mindlessly like that. All right. So there are a couple of business, and see, I keep forgetting to even open my notes. I can go and go and go. And you should hold me. Hold me, because if you don't hold me, I'll just keep going and going and going, because I love to do this stuff. But okay, so let's talk about it. There are different types of business entity structures. All right. So starting out, you could actually start running your business as a sole proprietor. A sole proprietor means you don't have to register anything anywhere. Right where you are, with your name, your social security number. Your social security number is a tax ID, by the way. You can go ahead and you can start a business. All right. Is it true that it has some risk? Yes. If anyone has heard about sole proprietorship, the biggest risk with that is that you have no protection, right? Which means if you started providing a service to someone and something went wrong, okay, that person can come and sue you, sue everything you own, even what your spouse owns, even money from other sources, they can sue you for that. All right. A lot of times people kind of shy away or frown when it comes to starting a business as a sole proprietorship. And they're like, oh, you're not serious. It makes you not look serious. But I'm one of those people where I think it always depends on where you are and what you have going on. Okay. So a sole proprietorship is the easiest form of business, because you're not really needing to go register anything. You can get yourself a DBA. A DBA is a doing business as name, where if I wanted to start a business now and I don't want to use my name, I would say, okay, Lilly doing business as, that's a DBA, doing business as Pretty Hair, Pretty Hair and Co, something like that. All right. Or Pretty Hair and Family, whatever name I choose. That's a DBA. I don't necessarily have a registered entity structure, but I'm starting out as a sole proprietor. I want to braid hair. I get a DBA for branding purposes, so I can come here and write it on social media that Pretty Hair and Family is in your neighborhood. We're braiding hair. Hire us. Okay, that's a sole proprietor right there. I've started my business. You pay me, I provide a service, we're good. Now, the only risk with this is I have no protection, like I said earlier. All right. But this entity structure could work for me for several reasons. One, if this business is something I'm only doing for like 2 weeks or I'm just testing it out, there's no reason for me to want to go to the state to go and register Pretty Hair and Family, right? As much as it would be great to go and register an LLC, Pretty Hair and Family, but what if I'm just trying it and I don't even know if I'm going to like doing people's hair? I don't even know if you know what I mean? Like, I'm just trying. I don't even know if my arthritis will let me continue doing this for a long time. I'm just testing it out. All right. I'm like, that's a good way to start. I'm fine with that. If you're going through, a season and you want to do something that is so seasonal, let's say you sell fruits and the fruits are like, there's this fruit. I went to one of my uncle's house and tried. I don't know the name of this fruit, but it's so good. Now that fruit only comes out during a certain season. I wish I could remember the name. I'll try to remember and write it down. When we went last time, harvested so many, but it's only there for a short period of time. Now, if they chose to sell this fruit, because it's so seasonal, yeah, do they really need to be getting the business registered? Unless they are scared that something could go wrong, someone ate the fruit. But if they're just doing something seasonal, or maybe you're someone who does graduation products and you only do it for like a couple of months, do you need a business registered? Yes and no, but for me, sole proprietorship is just as good. The next thing, if you're doing a business that has very little risk involved, starting out as a sole proprietorship is a good way. And the reason I say so is because there are so many business people that have good ideas, but they are so scared to start because they keep thinking about all the paperwork they need to file when they can go ahead and just start. Then, if they like it, they can go to the Secretary of State and register it. All right. But you can always start right where you are. Now, don't get me wrong. I'm not saying you need to stay there. And don't get me wrong. Don't try to start as a sole proprietor if you know your business has risk. Okay. So even the braiding, I was saying, I would not like to braid someone's hair if I don't have a certain level of protection. All right. I just use that as an example because I was talking about the DBA. But if you're braiding someone's hair, because there's liability involved in that, where you could go do something and they say you came and messed up their hair, they want to sue you, then at that point you don't want to start a business like that because you don't want to risk yourself. Maybe you have a cleaning business. You could go to clean and you break something in someone's house. If they have a very expensive paint, now you're in trouble. Okay. So with that in mind, you want to make sure that you have some kind of protection. All right. So instead of starting your business as a sole proprietor, like I was saying, you want to go ahead and register your business as an LLC. LLC stands for Limited Liability Company. What does that limited liability mean? It means if something goes wrong, the liability is limited to the company. So if I do something wrong, you want to sue me, you can only sue me to the extent of what I have in the company. Unless you can prove beyond reasonable doubt that I intentionally went out of my way to commit malice or something evil, there was some intent that is beyond business. But if I did something wrong in the normal course of running my business, which was not on purpose to cause harm, if you sue me, you can only come for what is in the business. Oh, this is important. Someone listening to me, I don't want to forget. If you're part of a partnership and you're signing documents, please, when you sign, always put your title. Put your title of the business so that you're not personally liable. And I'm going to come to that. Let me not forget. All right. So we just started. If you're starting out a business, the first entity structure you have is a sole proprietor. Do you need to get your business registered all the time? No, but you can always start as a sole proprietor. It's very easy. There's not much documentation to file. If you're testing out an idea, is good. If you're going through transitions, you can try something as a sole proprietor. I'm in a military town, so sometimes you have a lot of people that come to a town and they just want to do something short term. You don't want to register a business knowing that you're going to be moving. Then you have to figure out how to re-domesticate your company, which is something we'll talk about another time. So you can be a sole proprietor. When you're done, you move, you're good. All right. That's the first thing. But for protection, and in order to make sure that if anything goes wrong, nobody comes for you personally, you definitely want to register your company as a limited liability company. That's the second entity structure. Now, when we talk of limited liability companies, they are not necessarily the best when it comes to tax advantages. Now, what do I mean by this? Registering your business as an LLC does not automatically translate to tax benefits. No. When you register your business as an LLC, if you're a single member LLC, which means you're the only person who owns it, you and a sole proprietor, you get treated the same way when it comes to taxes. The IRS calls you a disregarded entity. When you file your taxes, you report everything on a Schedule C. And in the eyes of the IRS, your Schedule C is on your personal taxes. So they are not treating your business as separate. So if you're a single member LLC or you're a sole proprietor, you're treated the same way. So the LLC in itself does not come with an automatic tax benefit. But there's something the LLC gives you is tax flexibility. And because you're set up as an LLC, you can actually let the IRS know how you want to be treated for taxes so you can take advantage of the tax benefits, tax strategies, and all the stuff that is available for these different entity structures. So because you're set up as an LLC, you can choose to be treated as an S corp, you can choose to be treated as a C corp, and if you bring in additional people, you'll be treated as a partnership. All right. So our first entity structure was a sole proprietor, not the most ideal, but it's simple and it's good for those who just want to start. The next entity structure will be an LLC, and this one you have to register at the state level. It's great for protection, it's great for structuring, but it doesn't translate to immediate tax benefit. All right. So think about that. But the beauty is it gives you flexibility. All right. Then the next entity structure is what we call a partnership. A partnership is when two or more people come together to do business. Now, here's the interesting thing. A sole proprietor can form a partnership with another person, and there are two sole proprietors who have come together to do business, and they don't even have to get their business registered. Isn't that crazy? So if we came together and we shook hands, we can literally go into business as partners. Now, the only downside is just as the sole proprietor has no protection, that general partnership of two sole proprietors has no protection either. All right. And if something went wrong, they will be sued individually, come for everything. So now the best way to do it is either set up a partnership that you actually register a limited liability partnership, or an LLC that will be treated as a multi-member LLC. So multi-members, which means multiple people that came together and set up an LLC. So when you have a multi-member LLC, that now also translates to a partnership. Partnerships as an entity structure don't pay taxes at the partnership level. It flows to everybody's personal taxes based on the percentage of ownership. All right. Now, for someone who is listening to me, it's very important for you to note that you can have two people in a partnership, but they get taxed differently. All right. If you have one person that is a general member that makes decisions for the partnership, does all the work, administrative work, decision making, that person, when they file taxes, they have to pay what we call self-employment taxes. If you have another partner that is not involved in the running of the business and they just put money silent, their income is treated as passive. So they don't pay self-employment taxes on their own share of the profit. Very interesting stuff, right? So we started with the sole proprietor, we went to the LLC, now we move to partnership, and the partnership can be set up like two sole proprietors, or it can be a multi-member LLC. All right. The next entity structure that you're going to come across is what we call the S corporation. Now, the S corporation is not an entity structure you can register at the state like the LLCs, for example. The S corporation is an election you make to the IRS. You tell the IRS that I want to be able to benefit from all the stuff that the S corporation comes with, especially with my business being treated as separate from me. Remember, I told you guys the LLC gives you flexibility, but now when it comes to really enjoying the tax code, that's where the S corp comes in. The S corp is an election you make with the IRS. You tell them I want to be treated, my business to be treated as a small or sub-chapter corporation. It has its benefits. From there, your business is separate from you if you were a disregarded entity, which is an LLC. And what will happen now is your business can hire you, pay you a salary, deduct your salary as a business expense, and then whatever is left as profit, you don't pay any self-employment taxes on that. Okay, and I'm going to come back to the entity structures and the taxes that they pay. So the S corp, great entity structure. Now, guess what? Not only LLCs can become S corps. Even C corporations, which is our fifth entity structure, can also become S corps. Okay, so what's a C corporation? A C corporation is one of the entities that you do register at the state level. It's a separate entity from you, the individual. You register. It has a mind of its own to operate, to go into business, make money. All right, that's a C corporation. C corporations are great because they're the ones that can raise funding from all types of investors. There's no limit to how many people can be owners or shareholders of a C corporation. All right. Unlike, let's say, an S corp, for example, that cannot go over 100 people, the C corporation is more open to having investors or shareholders on the C corporation. Now, because the C corporation is a separate entity, it is the only entity that pays taxes at the business level. It pays 21% of taxes. All right. So it has this thing that they say double taxation. So if you're a small business owner and you go and you set yourself up as a C corporation, it might not be ideal for you because your profit will have to pay a corporate tax rate of 21%. And then when you take dividends home, you still have to pay capital gains tax. And capital gains tax could be zero if your income is really small, or could be 15% or 20%, depending on your total income. Okay. So now, remember, I said S corps are not only LLCs. So a C corp can also become an S corp. So if I set up my business as a C corp and it's not benefiting me, I can make the election for the IRS to treat me as an S corp so I can avoid the double taxation. Okay. So these are our five entities. We have a sole proprietor, we have the LLC, we have, and this is single member to be specific, we have the partnership, which can be two sole proprietors or multi-members, multi-member LLCs, or even just limited liability partnerships that are registered at the state level. We have the S corp, which is an election made with the IRS, and an LLC or a C corp can become an S corp. And then lastly, we have the C corporation. Okay, these are your five major entity structures as a business person. So now, if you're thinking about going into business, right? Remember, one of the questions I was asking is this something you want to be in long term? That was the first thing. And the reason I asked that question was if you should just go ahead and start as a sole proprietor. But guess what? It even gets more complex than that. Now we have to ask ourselves, do we plan to seek funding from investors? Because if you plan to seek funding from investors, then guess what? You want to be registered as a C corporation. Because as a C corporation, you can get foreign investors. Do you plan to bring in partners? Do you plan to go into partnership with your spouse, with other people? Then you want to consider setting yourselves up as a multi-member LLC, or if it's a professional partnership, you want to set yourself up right. Okay. Now, in your business, if you feel like if you're in a service business, for example, and you're right off the bed, you're the one doing the services in your business, you want to be on salary. Because if you become very profitable and you're paying self-employment taxes on your profit and still paying income taxes, that can be significant. So maybe you might want to become an S corp so that your company would pay you a salary that is tax deductible to your company, will help you save on that self-employment taxes, and still have the incredible benefit of the S corp. Right? So there are all these questions that you need to ask yourself. Don't just rush to the internet and start registering an LLC. Because if you just rush and register an LLC and then tomorrow someone reaches out to you, a friend of yours who is in Europe, and like, hey, I would love to be an investor in your company. Now it gets very complex. Not the end of the world, because there's paperwork we can file to fix that with the IRS, but there are several things that go into that we have to take into consideration when we are going out to register a business. Okay, so thinking about it, if you don't want to be in this long term, maybe a sole proprietorship will be better for you. If you feel like you're going to be in long term or you need protection, get your LLC. If you're going to get a partner, sole proprietorship might be good for like a quick project, where you have a general partnership where it's like two sole proprietors. It can be good for like a quick project where you call it joint venture, but you want to avoid that for the most part when it comes to partnership. So you better off setting up a multi-member LLC. And then if you want to be on salary, you want to ask the IRS to treat you as an S corp. And then most importantly, if you're ever going to get funding, if you're, ever going to, consider becoming a public company, set up as a C corporation. Okay, so these are things that I want someone who wants to set up a business to really think about. Okay, now let's talk about the tax implication, because I just explained these different entities, but how much tax do they really pay? And this is where now having tax planning and tax strategizing comes in really, really handy, you guys. Okay, in my world, because I'm a tax person, taxes are predictable. Let me just say that outright. Taxes are predictable. But you see why people are surprised when they get a tax bill is because they don't invest in tax planning. If you're my client and you and I work together, we know what your revenue is, we know what your goals are. There's no reason why we should be surprised when the year comes in and you're getting a tax bill. Because by then, we should have put together a plan of what strategies you should be leveraging before the year is over, based on your profitability, based on your goals for the next year, right? Because your goals do matter when it comes to taxes, because your tax information is used in a lot of areas of your life, like buying a home or getting a loan. All those different things for your business, they come in very handy. All right, so now let's talk about the taxes. I just talked about self-employment taxes. What is that? So you remember we're talking about the employee. When we talked about the employee, what did we say? When someone hires you, they pay half of your Social Security and Medicare, and then you pay half, right? And the total of that is 15.3%. That's when you're an employee. That's the beauty of being an employee, man. See, being an employee sometimes is nice. Eh? It's not easy to be a business owner. I tell people all the time. Some days I'm like, I just want to go for someone to hire me now. Anybody hiring CFO? I'm just joking. I mean, I love being a business owner without a doubt. But being an employee, you only pay half of your Social Security and your Medicare. When you work for yourself, you pay the full 15.3% of your Social Security and your Medicare, because nobody else has hired you. That's why they call it self-employment tax. Now, remember I told you when I started earlier, I said everybody pays income taxes. So you will pay Social Security and Medicare, but it doesn't end there. You also still have to pay your own income taxes. Okay? You still have to pay that. And then if you have state taxes, you also have to pay that. So think about it. If you're a sole proprietor and you make $100,000 from your business, and with your expenses, you have a profit of about $50,000. Guess what? On that $50,000, you have to pay 15.3% for Social Security and Medicare taxes. In addition, now to that, you also have to pay federal and state income taxes based on your combined income from maybe your other jobs and your spouse and all of that. So if that puts you, if you're in a high tax bracket, like a 37% tax bracket, well, there you have it. You're going to be paying a chunk in taxes. All right. So who are the people that pay self-employment taxes? The sole proprietor pays self-employment taxes. The single member LLC who files on a Schedule C pays self-employment taxes. The general partner in a partnership who does the work in the partnership pays self-employment taxes of 15.3%. Okay. Now, all of these guys still have to pay federal income and as federal and state income taxes. How do we save on these 15.3% taxes? Because it's not like you're going to avoid it. But what are the different ways for you to save on self-employment taxes? The top one is for you to make the election to be treated as an S corp. When you make the election to be treated as an S corp, what happens now is your company will pay you a salary, okay? Before I go there, let's go back. When you file your taxes and you had that profit of $50,000, in that profit of $50,000, the IRS treats it as money that you took home. That's why they tax all of it. So they're treating 50,000 as your pay. So it's not just profit, it's your pay. So they tax 15.3% on the full 50,000. When you become an S corp, you're telling them, wait, I want my business to be separate from me. Okay. So now out of that 50,000, your business can pay you a salary of 30,000. From that salary of 30,000, you're still going to have payroll taxes taken out. So you're also going to complete a W-4. Your business is going to withhold half of the Social Security and Medicare. You withhold some of it. And then from the 30 grand, your profit is only $20,000 now. Before, they would have taxed you the full 15.3% on what? On 50,000. When you become an S corp, you're only paying your payroll taxes from your 30,000 of your payroll. The profit now that is left as an S for your S corp it goes back to your personal taxes and you only pay income taxes on it. That's it. So you only pay federal and state income taxes. That profit doesn't get to pay the 15.3% of self employment taxes. Okay. So why is this good for you? This is really great for you because even as a business owner, you want your business to be able to pay you for the work that you're doing. You're the one making the decisions on the business. And then not only that, the moment your business becomes separate from you as an S corp, that's where all those tax strategies we talk about, like renting your home to your business, reimbursements, because now you're an employee. So there are certain expenses that you incur and your business reimburses you for that because you're an employee of the business, right? Of course, you need to have some paperwork in this, but the S corp comes with a lot of tax benefits where I feel like it's worth being considered. Should everybody become an S corp? Absolutely not. If you have 3 kids that can work in your business and you can pay, remember I told you guys last video, the standard deduction is 16,100. If you can pay each of your kids just $15,000, 16,100, that's the standard deduction. If you paid each of your kids 15,000 a year, 3 of your kids, that's $45,000. Well, if your profit was $50,000, guess how much money you just saved on taxes? In this case, becoming an S corp is not that much of a benefit for you, okay? Until at least your kids phase out. So these are things that, as much as they are great, they're not for everybody. So it's good to have that conversation with someone who can look at your situation and guide you accordingly. All right, this is very important. So now, when you can figure out, I have these different things going on, these are the strategies I can put in place, you can almost tell how much you're going to pay in taxes when the year comes to an end. All right. So now that kind of lays the foundation for taxes and for entity structure. So how do you go about registering your business? If you're someone who's been thinking about registering the business and you're ready, you've listened to this and you're like, you know what? I think I want to register an LLC. First thing I want you to do, get yourself a solid name. Okay. Get yourself a solid name. One thing I've learned before, people used to come to me and say, can I use this name? Can I use that name? I'll tell you the truth. Yes, it's true. Some names are catchy, others are not. But having been in business for a long time, nobody eats your name. People will eat good service and good value, but nobody cares about your name. I don't care what you call your business. If you provide good service at a good price and people know you're there and they can trust you, you're going to make money. Okay? Just pick a name you like. Now, someone who's listening to me who's a marketing person is going to be like, no, the name matters. I agree. But I'm not just as obsessed with the name just because. There's no name that has ever delivered good service. It's the people that provide the service. And when they provide the service, even if I cannot pronounce their name, I'll go back to them because of good service. So pick the name that you want, preferably a name that matches your space, but don't get too caught up with it. Okay? Because my worst thing is a business person who spends too much time thinking. I don't want that for you. Just get in it. Go. Pick the wrong name. You can change it, but just start. Okay. So pick a name. That's the first thing you want to do. Go on the state site. Every state has its own Secretary of State website. That's where you register businesses. Go on there. You want to make sure that nobody has your name or anything close, because a lot of people have lost business names or gotten sued because they had a name that was so close to an existing establishment and maybe it was beginning to impact their business. It happened to a client of ours before. Such an innocent thing, had no idea, came, set up business, 5 years in, get sued by another company. So things to think about. You just want to make sure nobody has that name, and then go ahead. If you want to reserve the name, you can reserve it. For me, if nobody had that name before, 9 out of 10, they're not coming with the name anytime soon. But reserve it if you have a strong conviction. Go ahead, and then once you're ready, go ahead and file your articles of organization if it's an LLC. But if you say you want to set up a corporation because you're going to have partners in Cameroon, you're going to have investors in Europe or in wherever, then go ahead and set up your C corporation. So you'll be filing your articles of incorporation. Okay. Once you file with the state is the one that gives you kind of like permission or, to operate in a jurisdiction. Once you get that filed, go to the IRS's website and then request to get an EIN. Okay, so you request to get an EIN. I wanted to share my screen, but we're already running out of time. I literally have 4 minutes. Get yourself an EIN. Once you get that EIN, you want to come back depending on how your business is being set up. If you have a partnership, you want to make sure that you have an operating agreement with the partners. Okay, you're going to need that operating agreement, which states, name of company, what you do, everyone's share of ownership, what each person contributed, all those things. You're going to need that once you get your EIN to go to the bank and set up a bank account. All right. Once you get your EIN, you do want to go to the bank and set up your bank account. All right. And once you set up the bank account, because here's my thing with that. That's very important. In fact, you guys bear with me. I think I have a little more time and I'm going to look into questions. So let me take a little bit of time. You want to set up your bank account because you don't want to keep paying for stuff outside of your personal money. Okay. You probably already use your personal money to register the company at the Secretary of State site. So you want to set up your bank account immediately and transfer money into that account. Remember, you don't yet have money coming in for your business, but you want to transfer it so you can start to track your business income, your business expenses. Okay. If you've listened to me long enough, I say it all the time. Your most important business activity is bookkeeping, is being able to track all the money that comes in and goes out. Taxes can be filed, amended, corrected, everything. But if your numbers are not right, you're always going to struggle because you're never going to know how your business is doing. If you're getting a return on your investment, of course, you're not even going to be compliant. You're going to miss out on opportunities if your records are not right. So one of the best ways of making sure your records are right is to make sure you have a separate business account right from the get-go. I remember when I started my business, the first check I got, I just ran to the bank, set up that. In fact, it was the day I set up my business, somebody came and paid me with a check. I just went to the bank, set up the account, and I didn't, so I could keep everything separate. You want to do that for yourself, all right? Once that is said, you want to go ahead and apply for your state, for your city or whatever licenses you need. Now, if certain businesses like nursing, they have certain state board requirements, so you want to at least make sure you're doing that. But at least you want to get your license to operate in your city. Every city you have to apply for a city license. Some charge like $50, some 100, but you want to get that so you know when you're operating, you're in good standing in your city. All right, and then market your product, your business, keep going. Just make sure that you're tracking your records. Make sure that once you start making money, depending on how you're set up, that you're doing your tax withholdings. And then every year you want to file your taxes and file on time. If you've been tracking your records, you're not going to have much of a headache. Of all these things I'm saying, please don't go start doing it without talking to a professional. Doesn't have to be me. Hopefully, this information helps you. But if there's a professional you trust, you can work with, go sit and talk to them. I always say the best time to meet a CPA is before you started your business, but even better right away. Okay. So if you are someone who was not certain, you went and registered a business, but it doesn't align with where you are, I'm happy to have a conversation. I have free 15-minute meetings you can take advantage of, or talk to someone else. You can always change your business entity. Maybe you might have to dissolve what you have and register a new one. They're different. Maybe you might have to do an election with the IRS. It's good to talk to a professional. Now, I always get questions of people saying, I registered my business maybe when I was in California. Now I'm in Ohio. What do I do? So there are certain states that have something called, that have a relationship where you can redomesticate your entity. I know if you've never heard that before, it means if two states have that relationship, let's say maybe Georgia and Virginia or Georgia and Ohio, if they have that relationship, instead of you dissolving your entity in Georgia and setting up a new one, you can redomesticate it. You're not going to lose anything. You don't even have to apply for a new EIN or any of that. You save your EIN and you can maintain your business history. I love redomestications for that. Other times, it may not happen, so you might have to shut down the entity structure and open a new one, or you might keep the entity structure and operate in your new city as a foreign entity. I don't like it. That's why I don't encourage anybody to set up an entity where they don't stay. People tell you, go to Delaware, go to Wyoming. You don't stay in Delaware and Wyoming. Why are you registering your business there? Only to come back and be functioning as a foreign entity in your own local state. Out of question. So I will encourage you, register in your local state. There are advantages that come. Sometimes there are state grants that come, but because somebody told you to go to Delaware and you went to Delaware, now you're looking like, an adopted child in your own home, right? So, all right, guys, let's see if I have some questions. Any questions for me? Remember, I told you the team made sure that I stay on Restream. So on Restream, I don't see anything. I don't get distracted. So, family man said, "Doc, you mean if someone sues me, my LLC will carry the liability?" Yes, 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 to an extent. Okay. So the idea of the LLC is the protection. It means if you were in your ordinary course of business, you were providing a service and something went wrong and they sued you, they can only come for what's in your LLC. So if your LLC has $30, that's what they're coming for. Don't get me wrong. If there's damage that was caused, you could be liable for it. But the thing is, they cannot come for you personally because it was something that happened in the course of you doing business. Okay. Yes, there might be, issues that you might have to or bills you might have to pay or something, but it's not, they don't come for you personally. However, if they can prove beyond reasonable doubt that you went out of your way and you did something shady, you see what I'm saying? Like you went out of your way to commit fraud, you went out of your way to be messy. At that point, they can come for you personally because now you're personally liable. You intentionally did something wrong. Yeah, that's a really good question. But the LLC does give you really good protection. So that's one of the reasons we encourage people to get it. But it may not always be suitable, in case you want to bring in foreign investors or and if you're just trying out an idea. See, I was talking about setting up an entity in one state and then now you're kind of limited because you're moving to another state and you have to go set up as a foreign entity there. So sometimes you might want to think about those things if you are just testing out an idea and you're moving. We see it a lot with military families that are constantly moving. Those are things you can always hold off on. Okay. Any other questions, you guys? I hope this was helpful. Sometimes it can be like a conversation overload, right? You see, I didn't even pick my notes because these things, like, I live and breathe this stuff and I get so excited when I talk about them. But I'm really hoping that they do help what you're building. I can add to what you're doing. I'm, fingers crossed. And if you have any questions that are very, peculiar to your situation and you want to have a private conversation, take advantage of my free 15 minutes meetings. You're not going to find a lot of CPAs that as, good as this one that will offer something like that. Take advantage of it. Okay. If you need a full hour of tax planning or tax strategizing, then you can also do that you can actually register on our website as well. Schedule that on our website. Is it book it? All right. So you guys, thank you so much. We had a little bit of a technical delay when we started, but we're here now. Thank you all for joining. Thank you for watching. If you have any more questions, feel free to send them to me. This has been nice. I hope you have an amazing day. And this is Dr. Lilly Mbinglo, your favorite and finest CPA and accounting professor, right? You guys be safe. Thank you. Bye for now. Awesome. And see everybody